Well, first up, let me introduce our very first guest on the show. We have with us Rachit Chawla, the founder and CEO of Finway, joining in. Rachit, hi, good evening, and thank you so much for giving us your time today on The Money Show. So first up, let's understand, when you say, generally retail participation in debt funds is a little low because usually it's used by, by corporates to manage their treasuries. However, debt funds are a great tool of investing. Now that there's been this spike in bond yields, and this is one of the reasons why retail investors don't like debt funds, because there's so many jargons right around it. So if you could just explain to our viewers and if you could dumb it down as much as possible, what do you mean by a spike in bond yield? What are the ramifications it has for different kinds of debt funds?
Okay, so let's not use jargons and let's use simple words. In simply put, what is a bond yield? Let's understand that in detail. So a yield is a return, and bond is a sort of a security which government or a corporate offers to consumers. That look, this is a bond which we are offering you. It has a yield, which is also called as a coupon rate. They invite the consumers to invest in their securities in return of a rate of interest. So bond yield actually means the rate of interest that the consumers should expect in return of their money. So suppose the coupon rate is 6%. When I say coupon rate, it's same as bond yield. So that means if a consumer invests 10 lakh rupees in a bond, then he's likely to get 60,000 rupees per annum as return, which is also a yield. So in times to come, suppose that bond is for 5 years, lock-in tenure, and we say that the bond yield has increased. That doesn't mean that the corporate or the government have started giving more interest. Basically, what it means is that because the bond prices have gone down, hence the person who has actually invested in a bond is looking for a exit at a lower price. Since the price is low, the yield automatically increases, and hence instead of 6%, it goes up to maybe by 1, 2, 3%, as you rightly said, and it has been on the up mainly because of the demand and supply factor. So that is for the consumers to understand that the yields are fixed at the time of the bond when it is offered to the consumer, but the fluctuation is due to the demand and supply.
Demand and supply of the bonds, essentially. So basically, all these bonds carry a fixed interest rate, 6%, 5%, 7%, etc. That does not change. Like Rachit mentioned, if let's say you've bought bonds worth 10 lakh rupees, every year, if it's fixed at 6%, you are going to get 60,000 only. However, it is the market yield that sort of changes, or rather the bond prices that change. So if the bond prices go down, this return, or this yield, rather, return may not be the right word, but this yield essentially goes up, and vice versa. If the bond price goes up, then this yield comes down. Okay, now Rachit, let's understand it from the aspect of debt funds, because usually when it comes to fixed income, investors and retail investors especially do tend to invest in debt funds. So between a long duration fund, a medium duration fund, and a short duration fund, how should investors across the spectrum of these debt funds understand what is the impact of this spike in bond yield? And also, would it differ, or should short duration and long duration bond holders think that, okay, it's gone up, that means it's negative for me, period?
Yeah, so again, it's very important for consumers to understand this. When they are investing in debt funds, they should always understand the tenure which is remaining for that fund. So suppose the tenure is very short, then the volatility risk also becomes short. But if the tenure is very large, say 9 years is left, 9 years will automatically have a lot of impact when it comes to volatility. So they will see their price fluctuate a lot. And when it comes to debt instruments between 1 to 4 years of residual maturity, when I say residual maturity, the bonds might be 10 years old, but only 1 to 4 years are left. then that means primarily the accrual of interest payments of those papers will actually define the prices of the bonds and the correction. As a consumer, if somebody has a horizon in mind, I would definitely suggest them to divide it in a way that even this volatility doesn't affect them so much. In shorter duration, volatility will be the least, but as the duration increases, the volatility will increase in terms of the yield and in terms of the bond prices.
So for shorter duration funds, the volatility in terms of yield and bond prices will be the least, but for the longer duration, the volatility will perhaps be a little more. So Rachit, to understand what you're saying, would, if let's say, you know, when I'm reading the news and I see, okay, bond prices have spiked, if I hold funds that are, you know, long duration debt funds, should I be worried? Should I expect that, okay, this is going to impact my debt fund in a negative way?
So bond prices have inverse relation with debt funds. So when we say bond prices have spiked, it will definitely put pressure on the underlying holdings, and they would come under stress. So if we take into account especially debt mutual fund portfolios, definitely as soon as the prices come down, it will have a negative effect on the debt mutual funds. But on the contrary, if you say the prices have gone up, that means the supply is limited but the demand has gone up. Hence, the mutual fund, if you're invested in a debt mutual fund, it will have a positive impact. So bond yields are inversely linked to the bond prices, but bond prices are directly linked with the mutual fund prices.
Yeah, because these mutual funds in turn obviously have bought into these bonds, right? So if bond prices go up or down, your NAV as well of these debt funds will go up or down. So that's why if you look at the entire equation, if your yields are spiking, then you know your debt funds which you hold may see a bit of a dip in NAVs. So currently, given the current macro environment, Rachit, I'm sure you as well have read the what the commentary is from the RBI, right? That's really the reason why we are seeing this sort of volatility in interest rates, or sorry, rather in bond yields. How do you think investors should invest their money across the spectrum of debt funds then?
So number one, investors need to diversify their portfolio. They should not invest in one certain type of securities. They should diversify their investments in terms of tenure also. So number one, diversification. Number two, which is very important, is whenever they're investing in any debt instrument, they need to check, where is the money being invested, in what kind of securities. Because there might be that there are n number of mutual funds, but they all invest in one type of securities only. So that means even while your mind thinks that you are diversifying your investment, you might ending up putting all your money in the same securities. So understanding the security is also very important. Thirdly, they need to understand the risk associated when it comes to entering that mutual fund and when it comes to exiting, because all these debt mutual funds carry an exit and an entry load. So they need to take that also in account. Fourthly, they need to summarize everything in terms of their objective. If their objective is short term, then they should never opt for a long term debt fund, because that will only lead to a lot of volatility and less peace of mind. So they need to take into account what is their end objective of investing in the mutual fund. Apart from that, they need to study about the fund they're investing in. If they are happy with the bonds and the underlying securities, only then move forward. So these are primary suggestions which consumers need to take, and everything is available online these days. The beauty is whatever detail about any mutual fund you would like to know, it's all there available on the internet on just a click away.
Oh yes, absolutely. We live in a world where it's In fact, the TMI syndrome is looming large, where people have a lot of information, and that's the reason why, we'd love to bring, we on the Money Show as well, love to bring Rachit to essentially help you skim through what exactly you need to read and what you should ignore, so that you as well can make sense of the news around you, of the data around you, and sort of understand what's the impact of all of this news on your money. So that's the reason why we decided to sort of address this news with respect to the spike in yields with Rachit. So thanks so much, Rachit, for joining us on that. Okay, Rachit, I just want to talk to you now, away from just duration debt funds, there are also different kinds of debt funds, in the sense the kind of securities these funds invest in. One is corporate bonds and the second one is government securities. So corporate bond funds and gilt funds. Gilt funds for the last 2-3 years have been having a great run. I mean, every year double-digit returns. And corporate bond funds have been seeing a lot of investor interest of late, more so because, today a corporate FD will give you a better interest, would give you some semblance of safety as well. Of course, it's not completely risk-free like a government bond is. And it's packed out into a fund. So that means you have that diversification, so there's no concentration risk. So let's talk about corporate bond fund first. What do you think of it? I mean, what kind of investors as well should put money in this?
So investors need to understand that all these corporate bonds carry a certain amount of risk associated to them. They need to they need to read properly the offering which the corporation is giving to the consumers. They should not get lured with high rate of interest, because I also see a lot of advertisement where they say, get fixed deposit of 13% per annum. Now we need to understand, if a corporate is providing 13% on their bond per annum, which is significantly high in terms of rate of interest, that means they're not able to raise money at low rate of interest. Otherwise, they would have never made this offer public to the consumers. However, the consumer need to see more details than that. Just the rate of interest should not be the decision-making point. They need to understand their credit rating. They need to understand the fundamentals of the company. They need to properly study whether the company will be able to provide the kind of returns the company is offering to the consumers on paper in real time. Because in the past, especially with all the situation and volatility going on, there have been incidences where these corporate bonds have defaulted. And when these bonds default, the consumer is the one who has to face all the heat. Ultimately, consumer feels it as good as a fixed deposit, but it is not in reality. So consumer needs to get into more detail about the company, the governance, the management doing it, and ensure that his money will come back in time as promised in the corporate bond by, offered by the company. So rate of interest, I feel, should not be the only criteria. It should be one of the factors involved when it comes to corporate bonds.
If I have to just put it in simple, what essentially to put it into perspective from a retail investor point of view, it's like this: if you do not have a good credit rating and you will go to a bank and ask them for home loan or a personal loan, they will look at your credit score, they won't be very pleased, and that's why instead of say maybe 7%, they will charge you 7.5%. So similarly, if a corporate may not have the best credit rating, in order to lure money, they will want to give you more interest rate. So that's something that Rachit as well has said, that you need to look at the history of this company. Have they been properly servicing all their payments? Because you do not want your money to be lost in limbo. It's happened in the past as well, right? We've had companies that have unfortunately not been able to service either the redemptions or the interest, and that's just left a lot of investors in a lurch. So that's the point Rachit as well is making, that just looking at the interest, however lucrative it sounds, like Rachit mentioned, 13% per annum, there's always a catch. And gilt funds, meantime, Rachit, basically they're just investing in government bonds, right? But still they're managing to give 12 and 13% interest rate. Does this have anything to do with yield volatility, or what is the reason for this great momentum that gilt funds have been clocking in? And do you think this should form a good chunk of my debt fund portfolio?
So gilt funds are the safest when it comes to, because it's backed by government securities. So it's considered to be the safest. The reason they have been giving double digit returns is that the interest rates are falling. And that's the reason they are pushing up the returns of gilt funds. I mean, there exists an inverse relationship between price and interest rates. So when the interest rates go down, the older securities become much favorable as they were giving better interest rates. So consequently, their prices will move up. Now, in the past few months, you must have seen RBI who's continuously reducing the interest rate. That is the reason why gilt funds are in great demand, because the prior gilt funds, they were giving significantly better rate of interest as compared to the new ones. Probably that's the reason why you see the spike and why they are in so much demand. End of the day, everything comes down to demand and supply. As soon as you see more demand and less supply, the prices are bound to go up. But as I said, gilt is one of the safest debt structures anybody can opt for. The underlying security is actually given by the government of India. Hence, it can be widely relied on.
Okay, all right. Well, yeah, I think one of the, you definitely, what you mentioned, the last bit especially, the fact that it's backed by the government of India, that's a sovereign guarantee of sorts that your money will be safe. It's got obviously the highest credit rating. And, maybe this entire COVID situation has got us very, very jittery as well about our money. And that's why you rather just put it in an investment. You may be thinking that, okay, it's okay if the returns are a little less, but at least I know that I'm going to get my money back. And who better than the government of India themselves to sort of give you that sort of assurance? And that's perhaps one of the reasons why, gilt funds have been seeing this momentum. Fund flows as well in gilt funds have been pretty good. So that's on debt funds. Well, great. There you have it, folks. If you have any questions or queries on debt funds, on this entire bit with respect to bond yields, we still have Rachit Chawla with us. You can email us on themoneyshow@etnow.tv and we will get your questions and queries answered right away. Let me reiterate our email address. It's themoneyshow@etnow.tv. But in the meanwhile, let's take on board some questions and queries we've already received and accumulated in our inbox. First up, we have Dr. Vireshwar Mekaraj, who says, I've invested in SBI Blue Chip, HDFC Midcap and Sundaram Midcap. I am a long-term investor investing for retirement. But his question is this enough? Should I have more funds? Well, unfortunately, Dr. Mekaraj has not mentioned what's the amount he's investing. He's not even mentioned his age, but since he's a long-term investor and he wants to invest in his retirement, assume he's young, he's got maybe 10 odd years in his hand or more. So yeah, just 3 funds, 2 mid-caps, 1 blue chip. Rachit, do you think that this may be a little too small a plan for, for something as monumental as retiring, and hoping that these funds will sort of help you live out your retired years?
So I suggest the correct way to go about it is to understand when do you plan to retire. Suppose you have 20 years to retire. Then you need to derive a value. What kind of quantum of money would you like to see in your bank account when you retire? Now the calculation needs to be done reverse. When you say you have invested in blue chip, that means you have invested in large corporations. And when you say HDFC Midcap and Sundaram Midcap, I would like to know more about the kind of quantum we are talking about. But for me, my suggestion is to also have Nifty 50 direct fund option in your portfolio, because what Nifty 50 does is it's got a very small expense ratio assigned to it, and Nifty 50 replicates the top 50 companies of India. So at any given point, these top 50 companies are bound to give good dividends and good returns. So suppose the 51st company is not working well, it automatically 50th company will go to 51st and 51 will enter Nifty 50. So that's also a very good option to have when it comes to retirement. I would suggest you do backward calculation and then accordingly, by way of SIP or lump sum investment, try to invest in these funds. Check about the fund manager, check about the past performance, and accordingly take a decision.
Okay, all right. There you have it. That's the recommendation coming in from Rachit. I hope, Dr. Mekharaj, this has helped you out, and good luck, of course, with your entire financial planning process. Okay, let's take on board our next query. It's coming in from Siddhant Gupta. He says, I'm a 24-year-old full-time trader, and from time to time I keep withdrawing my trading profits, setting it aside in a separate account for investment purposes. Now his question is, as a young trader, at what stage would you recommend one should buy a house, as it is a major financial and personal decision? Do you think that one should choose a rented premise over buying one and keep their investment untouched, for the purpose of buying a house? He's an individual in his mid-20s and he feels the urge, to have a house of his own. For instance, after having reached an investment corpus of say 3 crores in a few years, how much should one set aside for buying a house? The amount of buying the house would be from the investment portfolio itself. So like Siddhant has mentioned, it's actually quite a personal choice as well, but it does have a financial aspect as well. Unfortunately, in India, affordability of homes is very high, because not because house prices are too high, but because incomes as well on an average in India are not that high. So but if we have to keep that aside, essentially purely from a personal finance perspective, Rachit, what do you advise your clients when they come to you with this whole, and especially the younger ones, when they come to you with this whole buy versus rent dilemma?
So Siddhant, firstly, I would like to congratulate you. You are doing a very good strategy, because, just investing everything as a trader becomes too risky. And it's a good thing that you are putting all your profits as investment in, different stocks and different equities. From my standpoint, I think what you need to concentrate is building up the capital, because if you utilize your capital at this point of time in buying a house, then you might feel crunch when it comes to investing or trading. Right now, since last 3 months, the markets have been doing significantly well. What I would suggest you to do is keep looking for a house. Once you find a good house which suits your requirement, probably see at what level the market is. Suppose you think the market is really high, the price earning ratio is very high, and you feel that the market has reached a point where you don't feel comfortable keeping your entire portfolio, then is the time you might withdraw from there and then perhaps buy a house. But till the time market is giving you significant return on your investment, I don't think buying a house is a good option, because understand the opportunity loss. Suppose you're earning 20% from the markets, the house might not give you that kind of return. So if you have earned a lot of money, definitely that's the time to buy the house. Or you feel the market is overpriced, that's the time to cut down your investment and buy a house, as it's an important goal and a significant one for you especially.
Okay, Siddhant, I hope that sort of helped you, and guided you with respect to your dilemma on buying a house, and all the very best. We on the Money Show are always here to guide you with any further questions or follow-up questions you may have. Okay, well, Rachit, on that note, we're timed out. Folks, if we've not been able to take your queries, don't fret. You can always email us on the moneyshow@etnow.tv. We're always here at 5 p.m. to get your questions and queries answered. Rachit, thank you so much for joining us today on the Money Show and breaking down the entire concept of marrying yields and debt funds so beautifully. And on that note, we will take a very short break right here on the show. Don't go anywhere.